Hi everyone, my name is Amin Reina of Sage Investors, and I'm here to do a quick mind map analysis of JD.com. I recently made a decision to buy some shares in JD.com, and so I just want to walk you through sort of my thought process that led me to make that decision. Every time I'm looking at a company and every time I'm analyzing a company and their stock, there's some key questions I always ask each and every time I'm looking at a company. And essentially what I'm going to do is kind of walk you through how I answer these questions, what these questions are and how I answer them. And ultimately, hopefully at the end of it, I usually have a pretty decent idea whether I want to buy the stock or not buy the stock. And to me, it's a great way to build a little bit of structure and build a little bit of rigor in terms of how you analyze companies and how you try to figure out whether you want to buy or sell a stock. So JD.com, it's the company that I haven't had on my radar list, but it kind of popped up. As I noticed it because the stock price had been falling. It was in the 50s. And it's gone all the way down to, it was around the 36 level when I started to look at it. So I thought, let's take a look at this company. It might be an interesting opportunity about it. I knew a little bit about JD, but thought I'd do a little bit of a deeper dive just to get a better sense of the fundamentals of the business. So anytime I'm analyzing a company, first question I always ask, guaranteed question I'm going to ask is, what do they do? What do they sell? What is unique about them in terms of the products and services that they offer compared to other companies, similar companies? What is their value proposition? So JD.com, if you haven't heard, if you don't know, they're an online retailer in China. And they're not just any online retailer. They're considered to be the largest retailer in China. In a way, the easy way you want to kind of describe them is they're kind of China's version of Amazon. Similar type process, similar type offering, in a sense, anything goods, a lot of products, goods you want, you buy it online. They have an online, they don't have a store per se, clicks and mortars type store. It's all online, very similar, the similar shopping experience that you would find with Amazon. It's just China's version of it. They do offer some other types of services. One of the things that their claim to fame is their logistics service. Much in the same way that Amazon, in a sense, is not so much a retailer but a logistics company. Well, JD.com is in a similar way. They also have a financing branch. They have a finance branch, so they get very much into offering financial services, retail financial services. In a way, they're kind of like, in a way, a bank, which is something Amazon is not into, but JD has built a very lucrative and a very profitable platform on that side. As I said, they're essentially a website, but they've been branching out into developing more formal relationships, expanding their distribution platforms. So they've been partnering a lot more with companies like Tencent on the mobile side, getting their e-commerce capability out to the mobile site. They're also talking a lot about branching out into foreign territories, and one of the big ones is they are considering making a big push down the road to the U.S. and actually competing. They believe they can compete with Amazon. They have the infrastructure and the methodologies and the logistics to compete with Amazon. And that's interesting, but it'll be interesting to see how they do that. They're currently kind of building their infrastructure out in California, and they're serious about it. Who are the competitors? Well, the competitors are actually kind of limited because their focus has been predominantly China, mainland China. So their main competitors have been basically Alibaba and Tencent. Those are their primary competitors. You could say Amazon, but because Amazon isn't in China, there really aren't players yet. But eventually, if they were to make an expansion, then Amazon and companies like Walmart could become part of their competitive landscape, and there's good things about it and there's bad things about it. Who are the customers? Next question I asked is, who's the customer? Who would go to shop at JD.com? And clearly they're the largest retailer in China, so clearly they appeal to a real cross-section of people, probably targeting more to the younger crowd. That's at a very high level, but I did some digging also, and when you look at their breakdown in terms of sales, they seem to be targeting more, they appeal more to more of the affluent Chinese population. Their sales levels, if you look at their breakdown in sales, their sales in what are called Tier 1 cities, and those are your Beijing, Shanghai, that's where a lot of their sales come from. And when you look at their sales in the Tier 3s, it's lower. So a lot of times what I've learned is that people who have more money and are interested in higher quality goods are going to go to are going to skew their shopping more towards JD, higher quality goods, while people that have a lower income tend to gravitate to Alibaba. And that's something I didn't really know about. So when I look at JD.com, I would consider it to be a sort of that higher end retail experience that people are looking for. Question is, do people, it's a great thing, these are the customers now. The question is, do they shop at shop at JD once in a while, or are they recurring type customers? Because ultimately as investors, we want to see companies that are selling their products over and over and over again, lots of turnover, lots of constant recurring revenues. And from what I can see, given their sales numbers and performance numbers, it does seem to they have built a bit of a loyalty and increased likelihood that they will come back and buy more from JD.com. So that's kind of a quick nutshell of their customer base. Now the question we also always ask ourselves as investors is, that's great, they may be a great company and people like their products and services, but do they make money? Is this a profitable business? So when I looked at one of the metrics I kind of go to in terms of measuring financial performance and profitability and wealth creation capability is economic profit, which is taking a company's return on invested capital and then subtracting their cost of capital. And if it's a positive value, then that's a company that's creating tangible wealth, real tangible wealth. And ultimately, from my experience, investors put a premium on stocks where companies are generating positive economic profit consistently over a long period of time. So when I looked at JD, their return on invested capital over the last 3 years has ranged from 91 to 144%, which is insane. That's like an insane level of return that the company is generating. And when you compare it to the company's cost of capital, which is about 10%, this company is creating hyper economic profit. This company is creating a lot of wealth and a lot of tangible cash flow is being generated by JD.com. It's got a growth rate really, about a 20% growth rate, which is really, really high and really solid. So it's this type of growth rate that's really allowed it to become really the dominant retailer in China, especially on the online side of it. So that's great. Company's definitely creating wealth. That's what we want to see as investors. Now we got to start looking also a little bit at the financial position of the company. How financially strong is this business? Is this company going to go out of business in like 3 weeks? Or is this company durable enough that it can handle shocks, strong enough that it's going to be able to handle potential shocks that might occur down the road in the future? So this is where we want to look at the company's balance sheet. So when I looked at the company's balance sheet, one of the areas I look at is liquidity. The company's ability to meet its short-term obligations, be able to sustain itself on a day-to-day basis. And usually you can kind of capture that by looking at the company's current ratio. So the company's current ratio, which compares the company's current assets to its current liabilities, is under 1 right now. So which is usually not a good thing, because it means Company has a lot of expenses, a lot of obligations, and it may not have enough cash flow to be able to meet those obligations, which is a bit concerning. But then I kind of dug into the balance sheet a little bit, and I saw that the company's, right now, latest balance sheet I saw, the company has, in terms of cash, it has 3 times as much cash as debt out there. So if the company wanted to retire all its debt tomorrow, it can do it. Like, it has more than enough money to actually retire its debt, which is a great feature I always kind of look out for, because it shows me that really this company is financially strong and it's not going to go out of business tomorrow. And that's ultimately what I want to invest. I want to invest in high quality businesses that are going to be durable and last for a long period of time. I looked at the debt level, and if you look at the company's debt equity, it comes in around 0.25, which is pretty manageable. And I looked also at the quality of the company's assets. Does the company have a lot of goodwill or intangible type assets in there? Ideally, I don't want to invest in companies that have a lot of goodwill in there. I looked at the goodwill ratios, percentages for JD, and they're pretty low to non-existent. So when you factor these elements in, this is a company right now that seems to be creating a lot of tangible wealth, growing really, really healthy, and it's got a really, really solid balance sheet. So when I look at the financials, they're pretty rock solid and they're pretty great. And the fact of the matter is, it is the dominant player in China in terms of online retail. These are good things. These seem to be good things that I want to see as an investor. So, like anything, these are all good things that are happening right now with the company, but there's also, you got to look at the risks. What could go wrong with JD? What could knock this company down a few pegs? A couple of things that kind of jump out at me. One is this whole expansion concept. Like right now, the fact that they want to go into the US, that's going to require a lot of investment, a lot of capital, and it may not go well. And you're going against some real players here who are not spring chickens. These are very dominant businesses. So does JD have the capability to go in there and compete with these type companies? That's hard to tell. Then the fact of the matter is, this is a China story here we're talking about also. And so there are risks that the government could just clamp down on them. Doesn't look like it, but the nature of the system over there is China, the government could shut down companies tomorrow. So you have to put that on there. And I think one of the reasons why the stock has been under pressure is I think there's issues with trade wars and tariffs. And I think China companies have kind of come under a little bit of pressure because the U.S. is talking about inflicting all kinds of tariffs, especially on China, Chinese companies. And could that put increase of prices and inputs, which could potentially impact a company's financial performance down the road? That's a risk factor that has to be taken into account. So all in all, it seems like this is a pretty solid business, and it's actually creating tangible wealth. It's not like a dot-com of the year 2000. It's actually creating tangible wealth. That's all well and good, but as investors, I want to buy these stocks. I want to find these great companies, but I want to buy them at a decent price so I can have some potential upside for myself. So as I said, the stock has been falling. It was in the 50s. It's now in the 30s, mid-30s when I started looking at it. In terms of valuation, on a relative basis, it's pretty pricey. The forward PE is around 47 times forward earnings. And when you compare it to companies like Google and Baidu, for example, just to use those as example, they are coming in around 20. They're in the 20s. So it's a pretty expensive stock. On a discounted cash flow basis, the valuations that I've seen show the stock coming in between $47 to $60 a share. So as I said, right now it's trading at 36. So there's definite upside. There's definitely upside here. But right now, I think the stock is, I think, a bit out of favor. And I think part of it is due to some of these trade concerns. But what the reality of when I'm looking at this company is, this is a company that is generating $75 billion in sales, and is really has a market cap of only about 26 billion. So for an online company, it's generating 4 times amount of sales compared to a traditional bricks and mortar company. It's better than even what Amazon is actually doing if you just factor out all the AWS stuff. So at the end of the day, I kind of looked at, you know what, it's the best of breed retailer. It's targeting a really kind of high income kind of sector or demographic, and it's doing a really good job. It's offering those type of experiences that are making people come back. It's generating really solid economic profit, rock solid balance sheet. There are definite risks associated, but the fact of the matter is it's kind of holding its own right now. The stock is pricey, but the stock price has fallen in the last few months and is now at a $36 level. It is cheap compared to its discounted intrinsic value. So when I factored all these elements together, I thought, you know what, this is a cheap way of getting into kind of companies that are trying to own the iOS. I've talked about in the past about, I think the dominant businesses in the future are going to be companies that are able to own the operating system or the distribution. Companies that can control that distribution channel or can create a unique ecosystem and a platform are going to be the ones that are going to be probably have more of a higher valuation. And I think when I look at it in the way that the company is kind of trying to get more into the whole mobile side of it and trying to really position itself as that dominant China retailer, I think there's a lot of potential here, and I think there's a lot of upside in the stock. And so ultimately what it made me do is, when I factored all these elements together, it led me to say, you know what, I think I'm going to open and buy some shares here. So it ultimately led to my decision to buy shares in JD.com at the current price. I bought it at, I believe I bought it in at the 36.90 level. So we'll see how it goes. So if you have any more questions about this little mind map here or any of my other, you can find all my other mind maps that I've done. You can find them through my website, sageinvestors.ca. If you have any questions about my investment courses that I teach some online investing courses on buying stocks, how to buy and sell stocks and ETFs. You can check it out on my website again, and I'd be happy to answer any questions that you might have. So there you go. That's my mind map. Mind map that led me to my decision to buy shares in JD.com. My name again is Amin Reina of Sage Investors. Thanks for listening in, watching in, and we'll catch you again another time. Cheers.